B. Prasanna, Group Head, Global Markets with ICICI Bank joins us now. Prasanna, one side markets are worried about slowdown, and what I've learned over the years from folks like you who understand economy much more is that if there is fear of recession, then bond yield should come down. If there is fear of inflation, bond yield should go higher. So equity markets are falling. Why? Because there is fear of slowdown. Bond markets are rallying. Why? Because there is fear of inflation. How can both these fear coexist?
So I think the problem with this
It's the
correlation
right point, right?
analysis of the past,
It's the right question. First, tell me it's the right
I think
question.
it is a right question, except that it's possibly more relevant from a global perspective, Nikunj. So let me just explain for a minute. So I think what typically happens when there is a recessionary kind of tendency is for people to believe that bond yields will fall because you go from the safety to the safety of bonds away from risk assets like equities. But however, what has happened over the last, say, 2 weeks or so is the kind of volatility that has been created by policy making in the US has kind of led to lack of confidence in the institutional mechanism in the US, lack of confidence in what's going to happen in terms of future policy making. The uncertainty premium has shot up, and people basically don't want to. I'm talking about global investors, don't want to kind of invest in dollar assets as much as what they wanted to invest earlier. So what is happening here is that, and also bear in mind that tariffs have a stagflationary impact where you have a lower growth, but you don't have a lower inflation, but a higher inflation. But the argument was that the higher inflation was going to be transitory, it's going to be one time. And so central banks might look through it and hence might cut rates if they really fear lower growth. But what has happened also is that there seems to be a lot of selling by global investors in US bonds, basically due to a lot of geopolitical reasons, as well as due to fear of the dollar, whether how it's going to behave going forward. So in this kind of a scenario, when uncertainty is so high, past correlations typically tend to get broken. And that's the reason you're seeing in the equity, in the US markets, equity market as well as bonds, both falling at the same time. But if you look at India, for example, I think I would say that bonds have been pretty well behaved even when equities have been falling here. I wouldn't say that this kind of a negative correlation between the two markets in India will last forever. There are times when strong equity means strong inflows, and strong inflows means bond flow. It's also good for bonds, and so bond yields can also can fall. But I think right now what's happened is you've got an RBI policy which is so positive from a trajectory perspective on rates that market is taking heart from that. And if US bonds were not as volatile or global bonds were not as volatile and had not gone up, yields had not gone up, you would have seen much bigger fall in Indian bond yields than what we saw on Wednesday when the policy was announced.